International investing. What is it and why is it important? You may want to double check where your allocation is, particularly on the non-US side of things, because a lot of things have happened over the course of the past few years, and we think there's three solid reasons to be thinking more about internationally today, particularly in light of some of the things that are happening here in the US market. So we're going to share some of those things to be thinking about as it relates to your asset allocation on the international side on this segment on the program. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you simultaneously on the 96.9, the Game Network, along with News Radio WFLA Orlando. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So what exactly is international investing anyway in the first place? Well, it's owning companies that are headquartered outside the US. That's the very core of it today. And when you think about companies outside the US, we don't realize that a lot of what we use or a lot of what we consume is in fact made by companies that are headquartered outside the US. So if you enjoy Nestle products, that's a company that is headquartered outside the US. If you enjoy a Budweiser every now and then, talking about last night, having some beers with friends, the reality is, although we weren't drinking Budweiser, were we? Oh well. Anyway, the Budweiser would be a company that is now headquartered outside the US. So a lot of those products that we consume on a regular and daily basis, the reality is that they are in fact headquartered, or their corporate parent or umbrella that they sit under is in fact located outside the US. And the problem today is that many folks just sort of track the indexes, and perhaps the biggest one that is tracked, of course, is the S&P 500. Well, and so many different funds and so many different investments sort of gear to track that. But the problem with that is that the S&P 500 is in fact the 500 largest US companies. So that is solely very US centric. And so we're seeing a low overweight to non-US companies, yet non-US companies headquartered outside the US, in fact, make up over half of the market capitalization that exists on the planet today. So if you were to have a portfolio that in fact reflected global market capitalization, the majority of your portfolio would actually be outside the US. For many investors, the amount that is outside the US is in the teens or lower in terms of the percentages. We think that really does require some evaluation, particularly in light of sort of three concepts that we're going to share today. And it's certainly been easy to sort of steer away from the international side of things, particularly of late, because past 10, 12, 13 years, there's been the largest period of relative outperformance for the US markets to the international market. So it's easy to sort of wind up chasing, the stuff that's doing better. And if you don't actually do any kind of a rebalance over time inside your portfolio and just kind of let things run, well then, yeah, your US exposure would be much greater than it was a decade ago. Your international would be less, simply because of that spread in terms of performance. But there's definitely some things to be considering, particularly when you look at sort of the relative US versus non-US markets. And I think that the chief among them is this notion of concentration of the top five, the big dogs, if you will. And we've talked about this on the program before and referred to the S&P 500 as the S&P 5, given how big of an outperformance or how big of an over-contribution that the five largest holdings have in that index. To recap, if you look at those big five names, Apple, Microsoft, Amazon, Google, and Facebook, those five companies have contributed nearly 1/3 of the cumulative return for the S&P 500 over the course of the past 5 years. Let me say that again. Top 5 companies, 500 company index, top 5 companies, the FANGs, have contributed nearly 1/3 of the cumulative performance over the past 5 years for that index. That, folks, is the very definition of concentration. If you flip that and you look at that same top 5, like the 5 largest holdings in the international index, then you'll see that the 5 largest holdings, which, by the way, would be Nestle, Roche, Novartis, both those are drug companies. ASML, that's a big tech company. They supply like the supplies to chip makers and things like that. And then Louis Vuitton, Hennessy, which is a big sort of umbrella company that has all of those luxury good brands that make up part of its name, right? Louis Vuitton, Moet, Hennessy, all of that. And then, so you got fancy bags, you got liquor, I mean, you got champagne, you got the whole, the whole thing in there. So, but those 5 companies, 5 largest companies of the international index, have contributed about 6% of the total cumulative return for the international index over the course of the past 5 years. And obviously, you're the 5 largest companies of an index, you're still going to be a major factor in the performance. But when the top 5 here in the U.S. have contributed 30% and the top 5 outside the U.S. have contributed 6%, you tell me which one's more concentrated. I would be more concerned about what's been going on in the U.S., particularly when you have that level of concentration. So certainly something to kind of consider that, along with the other issue is that U.S. companies have disproportionately engaged in share buyback. You haven't seen that happen in other places around the world. And let's just recap what share buyback does. If I'm a company and I buy back shares, right, that means I have less shares outstanding, which means then that if I have X number of earnings and I'm dividing it by a smaller amount, that means my earnings per share is in fact better than what it would otherwise have been had all of those shares still been outstanding. So another trick that U.S. companies in particular have done is by doing all these share buybacks, they've been able to kind of continue to keep their earnings per share growing steadily because there's simply less shares out there. So that alone is also another distinction. Hasn't really happened much on the international side. So the earnings on the international are, relative to the number of shares, a little bit more robust because you haven't been spending money to buy back the shares. And then the other thing, of course, is valuation. Let's not forget valuation. When you look at simple ratios like the price-earnings ratio, which is a traditional measure of measuring value of a particular company, you look at its price, the stock price that it has, versus the earnings, and obviously you want that PE ratio to be as low as possible, right? Because you don't want to have to overpay for earnings. So the PE ratio is a very traditional metric for measuring relative valuation. Today, if you look at the S&P 500, you'll see that it's at about 33, 34x, meaning in terms of that PE ratio, and historically typically around 27. Meanwhile, if you flip over to the non-US side of things, you'll actually see where PE ratios there are about 15x versus traditionally being about 17x. So in fact, there really does, when you look just simply at the valuation metrics, that it really does seem to be a much more of an opportunity on the non-US side of things than the US. So bottom line, we encourage folks to rethink their international mix. Number one, you got to figure out where it is today. Check it out, make sure exactly what that number is as a percentage of your portfolio, and then sort of consider the opportunities, right? You've got some interesting things about concentration and buybacks and valuation that we've shared with you here on the program to be thinking about as it relates to your portfolio. With that, we'll take a break and continue on after these messages here on Dollars and Cents with your host, Joel Garris of Nelson Financial Advisors.